Sarah was 28, earning $62,000 a year at a marketing firm in Chicago. She had a decent apartment, a small 401k, and felt pretty secure. Then the economy shifted. Her company announced layoffs. Sarah was let go on a Tuesday morning. She had no emergency fund. Her investments had dropped 22%, and she had no idea what was actually happening or why. What she experienced has a name, a recession, and understanding it would change how she handled money forever. Today, we're breaking down exactly what a recession is, what causes it, and what it means for your financial life. Let's start with the definition. A recession is a significant decline in economic activity that spreads across the economy and lasts more than a few months. In the U.S., recessions are officially declared by the National Bureau of Economic Research, the NBER. The common rule of thumb is 2 consecutive quarters of negative GDP growth. That means the economy is actually shrinking. But the NBER looks at a broader picture: jobs, income, spending, and industrial output. For Sarah, the recession wasn't just a headline. It was a pink slip, a falling 401k balance, and suddenly wondering how she'd pay rent. That's the real-world input of economic contraction. Recessions don't just appear out of nowhere. They have triggers. Sometimes it's the Federal Reserve raising interest rates to fight inflation, which slows borrowing and cools spending. Sometimes it's an asset bubble bursting, like housing prices in 2008. Sometimes it's an external shock, like the COVID-19 pandemic in 2020, which froze the economy almost overnight. For Sarah, her firm lost major clients when businesses tightened their budgets. Companies cut marketing spend first. That domino effect, businesses spending less, hiring less, consumers spending less, is exactly how recessions spread. One sector slows down and it ripples through the entire economy. Here's what recession data actually looks like in real life. This chart shows U.S. GDP growth quarter by quarter over the last 2 decades. Notice the sharp drops, 2008 and 2009 during the Great Recession, and that near vertical plunge in early 2020 when COVID hit. Those gray-shaded bars, those mark official NBER recession periods. Sarah would have seen her firm's revenue chart looking a lot like this: straight down, then a slow climb back. The key insight here is that every single recession in this chart was eventually followed by recovery. The economy contracted, then expanded again. That pattern is critical for understanding how to respond. Here's the number that helped Sarah shift her mindset. According to NBER data, the average U.S. recession since World War II has lasted just 11 months. The longest, the Great Recession of 2007 to 2009, lasted 18 months. The shortest modern recession? Just 2 months. That was COVID in 2020. Recessions feel endless when you're in them. Sarah spent weeks convinced the economy was never coming back, but the data tells a different story. Recessions are temporary. They're a normal, if painful, part of the economic cycle. Knowing that changes how you respond. You stop making permanent decisions based on temporary circumstances. When a recession hits, the job market takes the most visible hit. Companies cut costs, and labor is usually one of the biggest line items. Unemployment typically spikes quickly. During the Great Recession, unemployment climbed from 5% to nearly 10%. During COVID, it hit 14.7% in just 2 months, the fastest rise in U.S. history. Sarah was in marketing, a field often considered discretionary, meaning one of the first to see cuts. The important thing to understand is that job loss in a recession is often systemic. It's not just performance reviews and bad luck. If you lose your job in a recession, you're far from alone. That's also why your emergency fund, ideally 3 to 6 months of expenses, is your first line of defense. This chart pulls live unemployment data and tells the story clearly. Watch the line. It's relatively stable during good times, then rockets upward the moment a recession hits. The 2008 recession pushed unemployment to 9.9%. COVID-19 in 2020 caused the fastest spike ever recorded, but here's what Sarah needed to see. After each spike, unemployment came back down. It took time, years in some cases, but it recovered. For investors, this chart is also a signal. High unemployment usually means the Fed will eventually cut interest rates and stimulate the economy, which has historically been good for stocks over the medium term. Recessions are painful, but they're also part of the cycle that leads to the next expansion. When Sarah saw her 401k drop 22%, her first instinct was to pull everything out and move it to cash. That's one of the most common and costly mistakes people make during a recession. Here's what the data shows. Stock markets frequently decline 20 to 40% or more during recessions. The S&P 500 fell about 57% from peak to trough during the 2008 financial crisis. But investors who stayed the course and kept contributing saw their portfolios fully recover and then grow significantly beyond their pre-recession levels. Bonds often behave differently from stocks, sometimes holding steady or even rising when equities fall, which is why diversification matters. Recessions test your investment strategy. The investors who come out ahead are usually the ones who don't panic. Here's the stat that Sarah printed out and taped to her wall. 100%. Every single recession in U.S. history has been followed by an economic recovery and market rebound. That doesn't mean it's fast. The recovery after 2008 took years. And it doesn't mean there's no pain along the way. But if you're a long-term investor, meaning you're not going to need this money for 10 or 20 years, historical data suggests staying invested through downturns has consistently been the better strategy. This is for educational purposes only, and past performance doesn't guarantee future results. But the pattern across over 75 years of data is hard to ignore. Sarah stopped checking her 401k balance every day and let it ride. 18 months later, she was back above where she started. So, what did Sarah do differently after living through a recession? She built her financial foundation so the next one wouldn't knock her over. First, she built a real emergency fund, 3 to 6 months of living expenses in a high-yield savings account. Second, she tackled her high-interest credit card debt, which becomes a much heavier burden when your income is uncertain. Third, she diversified her 401k across stocks, bonds, and different sectors, not just her company's stock. And fourth, and this is the big one, she kept contributing to her retirement account even when markets were down. Buying when prices are lower through dollar-cost averaging means you're positioning yourself for the recovery. Preparation isn't about predicting the recession, it's about being ready regardless. Sarah went from blindsided and scared to financially prepared. Today, she has a 5-month emergency fund, a diversified Roth IRA and 401k, and zero credit card debt. When the next economic slowdown hits, and at some point it will, she'll be ready. Here's what we covered today. A recession is a significant, broad decline in economic activity, typically lasting around 11 months on average. They're caused by rate hikes, bubbles, and shocks. They spike unemployment and drop markets, but they end every single time in U.S. history. Your job isn't to predict them, it's to prepare for them. Build your emergency fund, stay diversified, keep investing for the long term. And remember, knowledge is the first step toward building real, lasting wealth. Everything in this video is for educational purposes only and does not constitute financial advice. Please consult a licensed financial advisor before making any investment or financial decisions. Past performance